In August 2024, the owners of every NFL franchise gathered for a vote. 32 of the most powerful men in American sports. One item on the agenda. Should private equity firms be allowed to buy into NFL teams? 31 voted yes, 1 voted no. The lone dissent was Mike Brown of the Cincinnati Bengals, one of the last owners who still runs his franchise the old way. Family money, no outside investors. The game as a legacy, not a portfolio. He was outvoted 31-1. By the end of that week, firms like Arctos Partners, Ares Management, and 6th Street had committed a collective $12 billion to enter the league. Most fans never heard about it. The ones who did were told not to worry, that the money would go towards stadiums, better facilities, enhanced fan experience. What nobody explained was what these firms actually are, what they expect in return, and what happens when the people who own a piece of your team have a legal obligation to deliver returns to their investors, not to win games, not to keep ticket prices reasonable, not to honor 70 years of tradition, to make money. This is Backroom. Today we're going inside the quiet financial takeover of professional sport. For most of the 20th century, owning a sports team was not a financial strategy. It was a status symbol, a rich man's hobby. The NFL built its ownership rules around this premise. Individuals or families only. No corporations, no funds, no institutional money. The logic was simple. If you let Wall Street in, you'd lose something essential, the accountability that comes from having your name on the door. Then something happened to the price tag. In 2013, the average NFL franchise was worth $1.2 billion. By 2024, that number had risen to $5.7 billion. The Dallas Cowboys, worth $11 billion, are now more valuable than most Fortune 500 companies. Writing a $5 billion equity check is not something most billionaires can do alone. Even the ultra-wealthy started looking at NFL ownership and thinking, I need a partner. In 2019, MLB moved first, allowing private equity to acquire up to 30% of any franchise. The NBA and NHL followed, then MLS, then the NWSL. The NFL held out until 2024, the last major American sports league to open the door. The vote was 31-1.
I paid $154 million for the Dallas Cowboys. My little ass was really at risk here.
Now it's worth $11 billion.
Private equity firms raise money from institutional investors, pension funds, university endowments, sovereign wealth funds. That money is pooled and deployed into assets with one goal: generate returns inside a fixed window, typically 7 to 10 years. Find undervalued assets, optimize them, exit at a profit. For decades, sports franchises weren't considered suitable, too illiquid, too dependent on on-field performance, too emotional. Then a small group of investors looked more carefully at the numbers. Sports franchises had something almost no other asset had: a guaranteed revenue floor. The NFL's broadcast deals run to 2033, worth approximately $110 billion in aggregate. The NBA just signed an 11-year deal with Amazon, Disney, and NBC Universal, worth $76 billion. These aren't projections, they're contracts. Locked-in revenue, paid regardless of how the team performs. Add sponsorship, naming rights, merchandise, and ticketing, and you have an asset that behaves more like a royalty stream than a business. Predictable, recurring, and unlike any normal business, the leagues limit supply. There will never be 33 NFL franchises unless the league decides to expand. Scarcity drives value. Values only go one direction. The firm that understood this earliest was Arctos Partners. Founded in Dallas in 2019, Arctos was built on a single thesis. Professional sports franchises are the best risk-adjusted asset class most institutional investors have never been able to access. They started buying minority stakes: the Golden State Warriors, the Utah Jazz, the Philadelphia 76ers, the Los Angeles Dodgers, the Buffalo Bills. By 2024, they held stakes in over 20 franchises across 5 leagues, the only firm approved to invest across all of them. Then in February 2026, Arctos was acquired by KKR. $723 billion in assets under management. The firm that invented the leveraged buyout. The firm that inspired the book, Barbarians at the Gate. The deal was worth up to $2 billion. KKR's stated goal? If you're doing anything in sports, they want to be your first call.
We believe together we're going to be able to build a $100+ billion business.
6th Street, Ares, Blackstone, Carlyle, all running parallel strategies, all now holding stakes across multiple leagues simultaneously. This is not a hobby. This is infrastructure investment. And here's what that means for fans. These firms have a legal obligation to return money to their investors inside a defined window. The NFL requires a minimum 6-year hold. 6 years from 2024 is 2030. By 2030, these firms need to show their investors what the money did. The mechanism for that is franchise value appreciation. Franchise values go up when revenues go up. Revenues go up when media rights renew higher, when stadiums expand premium seating, when ticket prices rise. Ticket prices rising is not a side effect. It is the mechanism. The average NFL ticket price has risen every year for a decade. New stadiums, funded in part by private equity capital, are being designed with fewer general admission seats and more premium club-level options. The fan who paid $40 for a seat in 2010 is not the target customer of the 2030 arena. Nobody is saying this out loud, but the math makes it inevitable. The leagues will tell you there are protections in place, and there are, technically. Private equity investments in the NFL must be passive. No voting rights, no influence on team management. Stakes are capped at 10% per fund. The approved investor list was carefully vetted. But passive ownership in a business you have a financial stake in is a fiction that only holds as long as everyone agrees to maintain it. The pressure is structural. If you own a piece of a franchise and you have a legal obligation to generate returns, you will, at minimum, be very interested in the decisions that affect your investment. Stadium deals, broadcast negotiations, ticket pricing strategy. Mike Brown of the Bengals, the lone dissenter, understood something the other 31 owners voted past. Once you let institutional capital into the room changes. He lost the vote, but he wasn't wrong.
I just want it to work, and you've seen just the last couple years what it meant to the city. It just lifted up the whole city during that playoff run. For me, I'd like to keep the winning going, keep the believing going, have this be a fun thing for Cincinnati.
What makes this moment genuinely unprecedented is the scale of consolidation. Arctos, now inside KKR, holds stakes in over 20 franchises across 5 leagues. Ares, 6th Street, Blackstone, Carlyle, each holding multiple stakes across multiple leagues simultaneously. The same fund can own pieces of teams that play each other in the playoffs. This has never happened before in the history of professional sport. What happens at a collective bargaining table when the other side represents investors with stakes across 30% of the league? What happens when the next media rights deal involves a platform one of these firms also has a financial interest in? What happens when a franchise is struggling and the 6-year hold period is almost up? These questions don't have answers yet. We're still in the early innings, but the game has already changed. Your favorite team has a new kind of owner. You probably don't know their name. They didn't grow up watching the team. They have no allegiance to the city. What they have is a spreadsheet and a legal obligation to make it work. New episodes of Backroom drop every week on Plain Sight. If this one made you think differently about who actually controls the game, there's more where this came from.